In 1980, Zambia owed $2.4 billion. Over the next 20 years, it paid back $4.9 billion in interest and principal. By 2000, it owed $6.5 billion. Zambia paid back more than double what it originally borrowed, and somehow ended up owing almost 3 times as much. That's not a calculation error. That's the debt loop, and it has trapped more countries in poverty than any war in modern history. Most people think of debt as straightforward. You borrow, you pay back, you're done. But for entire nations, debt works differently. It doesn't get smaller. It multiplies. And once you understand how, you'll see it happening everywhere. Let's start at the beginning. A newly independent country approaches an international lender, the World Bank, the IMF, or a consortium of private banks. It needs money for infrastructure, relief, or budget shortfalls. The loan is offered. The country accepts. So far, this seems reasonable. But here's the critical detail nobody emphasizes. The loan is denominated in foreign currency, usually dollars or euros, not the country's own money, someone else's. This matters enormously. When you borrow in your own currency, you have leverage. You can adjust monetary policy. You can theoretically print more money if needed. When you borrow in someone else's currency, you have no lever. You must earn that currency. You must export goods, attract foreign investment, or borrow more just to pay what you already owe. This currency mismatch is the foundation of the loop. It immediately puts the borrowing country at a disadvantage. The country's income is denominated in local currency. Its obligations are denominated in foreign currency. Every time the local currency weakens against the dollar, which it almost always does when a country is struggling, the debt suddenly becomes more expensive to service. The balance doesn't change on paper, but the real burden jumps. A country needs dollars to make its payments. To get dollars, it needs to sell something the world wants. For most developing countries, that means commodities. Copper, coffee, cocoa, oil. Raw materials dug out of the ground or grown in the soil, sold on global markets at prices the country does not control. This creates a critical vulnerability. When commodity prices are high, the math barely works. The country earns enough to cover its debt payments, fund basic services, and keep functioning. The debt feels manageable. The government makes its payments on time. Nobody's worried. But commodity prices always fall eventually. This isn't speculation, this is historical pattern. Copper prices crash. Oil prices collapse. Agricultural commodities flood the market. Suddenly, the country's export revenue shrinks by 30, 40, 50%, sometimes more. Here's where the trap tightens. Debt payments don't shrink. Interest keeps compounding regardless of what happened to global commodity prices. The country still owes the same dollar amount. It just earned 30% less to pay for it. Now the country faces a choice that isn't really a choice. It could cut spending on everything else. Healthcare, education, infrastructure maintenance. It could let services collapse and people suffer. Or it could do what governments in this situation almost always do, borrow more. Not because it wants to, because it has to. The only way to cover this quarter's debt payment is to take on fresh debt. New loans to service old loans. New interest stacked on top of existing interest. The total balance climbs even as money flows out of the country in a steady, quiet current. This is the loop forming. The country isn't solving its problem. It's deepening it. And here's what makes it so durable. The lenders are still getting paid. Their interest is still flowing. The system isn't broken from their perspective. It's working exactly as designed. Let's trace what happens next. A country takes an initial loan at 6% interest. Year 1, it pays the interest. Year 2, still paying. But commodity prices have fallen. The government runs a deficit. It takes a second loan to cover the gap. Now it's paying interest on 2 loans. Year 3 gets worse. Prices haven't recovered. The government needs another loan just to service the previous 2. The balance sheet now shows 3 loans, each with its own interest rate, each with its own maturity date. The original debt becomes almost irrelevant. What matters now is the servicing, the interest, the fees, the penalties, the refinancing costs. The country isn't paying for the road it built or the school it opened. It's paying for the privilege of still owing money for those things. And this spiral can go on for decades. Put real numbers to it. In 2023, developing countries paid over $443 billion in external debt service. That's interest and principal on foreign currency loans, just interest and principal. Sub-Saharan Africa alone spent more on debt service than on healthcare or education in multiple countries. Ghana was spending over 70% of its government revenue just on debt payments. 70%. Before a single teacher was paid. Before a single hospital was stocked. Before a single road was repaired. These aren't failed states that refuse to participate in the global economy. These are countries that did exactly what they were told. They opened their markets, they took the loans, they followed every instruction, and the debt kept growing. The loop kept tightening. When a country can't pay its debts and turns to the IMF or World Bank for a rescue package, the money comes with strings. These strings are called conditionalities, and they typically include the same set of demands across different countries, different continents, different eras. Cut government spending, reduce public sector wages, eliminate subsidies on food or fuel, privatize state-owned enterprises, devalue the currency, liberalize trade, open capital markets to foreign investors. These conditions sound technical, but their effects are immediate and brutal. The government cuts fuel subsidies, transportation costs spike overnight, food prices spike, the cost of living jumps, people can't afford to eat, people protest, sometimes violently. The government cuts public wages or freezes hiring, services deteriorate, hospitals lose staff, clinics close, schools lose teachers, education grinds down. The government privatizes a state utility. A foreign company buys it, raises prices, and repatriates profits to shareholders in London or New York. Capital flows out of the country. The people who owned that utility locally, they're now customers paying higher prices. They don't benefit. Trade liberalization floods local markets with cheaper imported goods. Domestic producers can't compete. Small industries collapse. Unemployment rises. The tax base shrinks. Government revenue falls. The country, now poorer and less stable than before, needs another loan. This cycle has repeated so consistently in so many countries across so many decades that it stopped being an accident. Jamaica between 1990 and 2013. Argentina, Sri Lanka, Pakistan, Egypt. The script is almost always identical, and the person who suffers isn't the government that borrowed recklessly, it's the population trapped inside. Jamaica is a particularly haunting case study. Between 1990 and 2013, Jamaica paid more in debt service to international creditors than it received in total aid, loans, and investment combined. Think about that. Money didn't flow in, it flowed out. For 23 years straight. The country ran on a treadmill and ended up further from the finish line than where it started. At one point, Jamaica's debt to GDP ratio exceeded 140%. It was spending more than half its annual budget on debt. Not on roads, not on hospitals, not on schools, on interest to foreign lenders. During this period, Jamaica's healthcare system deteriorated. Its education system struggled. Its infrastructure decayed. All while the country was making its payments on time, honoring its commitments, following the rules. By every metric of international finance, Jamaica was behaving responsibly, and that responsibility impoverished it. The cruel irony is that Jamaica isn't considered a crisis case. Not compared to Argentina or Sri Lanka, Jamaica is considered a success story in some circles, a country that maintained its obligations, that honored its commitments. The framing itself tells you whose perspective the system is designed around. Jamaica's experience isn't unique, it's typical. Dozens of countries have lived through versions of this same trap. What makes Jamaica's story significant is that it's so clearly documented, so publicly available, and yet so rarely discussed as what it actually is. Not a failure of governance, though governance failed, but a structural feature of how debt functions between unequal parties. The creditor side of the equation has changed dramatically in the last 20 years, and the new landscape is even more complicated than the old one. Historically, most developing country debt was owed to multilateral institutions like the IMF and World Bank or to wealthy governments, the so-called Paris Club creditors. These lenders were at least theoretically accountable to some form of international governance. They could be pressured into debt relief. They signed on to initiatives like the Heavily Indebted Poor Countries program, which forgave portions of debt in the late 90s and 2000s. But today, a growing share of developing country debt is held by private bondholders and by China. Private bondholders, hedge funds, asset managers, pension funds buy sovereign bonds on the open market. They have no obligation to negotiate, no incentive to forgive, no mandate beyond return on investment. When a country defaults, these creditors can and do hold out for full repayment, sometimes suing in international courts. There's even a specialized term for the worst of them: vulture funds, funds that buy distressed debt at a discount and then demand full face value, knowing the country is desperate and has few options. Then there's China, which has become the single largest bilateral lender to developing countries on Earth, primarily through the Belt and Road Initiative. Chinese loans are often secured against specific assets: ports, mining rights, oil exports. The terms are not always publicly disclosed, and unlike traditional multilateral lenders, China has historically been reluctant to participate in coordinated debt relief. So, a country in debt distress in 2024 doesn't face one creditor. It faces a fractured, competitive web of creditors who don't agree on terms, don't coordinate on relief, and actively undermine each other's positions. When a country can no longer pay, it enters debt restructuring. This should be straightforward. Creditors and the debtor agree on new, sustainable terms. Payments are extended. Interest is reduced. Everyone moves forward. In theory, yes. In practice, restructuring becomes a nightmare because the creditors no longer speak with one voice. Private bondholders want full repayment. China wants security over its assets. The IMF wants structural reforms. Paris Club members want coordination. Each creditor has different leverage, different goals, different timelines. Getting them all into the same negotiation is like herding cats that actively hate each other. Sri Lanka spent more than 2 years after its 2022 default trying to get all its creditors in the same room. Some still aren't there. Meanwhile, the country is in free fall. Currency has collapsed. Inflation is soaring. People are rationing fuel and medicine. The government can't function. But restructuring negotiations crawl forward at glacial speed because creditors can't agree. This lag time, the months or years between default and restructuring agreement, is devastating. It's not empty time. During restructuring, countries typically cut spending further. They raise taxes. They stop investing in anything not essential. Hospitals operate without supplies. Schools operate without materials. Road maintenance stops. Infrastructure decays. The people inside the country pay this price while creditors negotiate. And when restructuring finally happens, it's usually smaller than it should be. Creditors know the country is desperate. They know restructuring will be painful. So they demand steep haircuts on only a portion of debt, meaning the country still carries an unsustainable load. The loop doesn't break. It just pauses, then tightens again.
Here's what makes this whole system so difficult to challenge. It's not illegal, it's not hidden. Every loan was signed. Every term was agreed to, at least on paper. Governments that borrowed bear responsibility. Corruption, mismanagement, and political dysfunction are real. No honest account of the debt trap ignores them. But responsibility isn't the same as design. You can acknowledge that a borrower made mistakes and still ask whether the system was built to correct those mistakes or to profit from them. You can hold a government accountable for reckless borrowing and still notice that the lender knew the loan was high risk, charged accordingly, and got paid regardless. And you can ask a more uncomfortable question. If the debt was truly unpayable from the start, if the interest rate, the currency mismatch, the commodity dependence, and the structural conditions made repayment impossible, then what was the loan for? Is it development or was it leverage? Because debt is leverage. A country that owes you money is a country that takes your calls. A country in debt distress is a country that accepts your conditions. A country that can't say no to a creditor is a country that can't say no to a military base, a trade deal, a vote at the United Nations. This isn't conspiracy theory. This is documented foreign policy, studied in academic papers, discussed openly in policy circles. The debt loop isn't just a financial trap. It's a geopolitical tool, and the countries caught in it are not just poor. They are structurally subordinated to the countries that hold their debt.
Today, there are roughly 54 countries that the United Nations considers to be in debt distress or at high risk of it. 54 countries. These collectively hold over 1 billion people. Many are in Africa, South Asia, and the Caribbean. Many are sitting on natural resources the rest of the world desperately needs. Cobalt, lithium, copper, rare earth minerals. The resources required for the energy transition. The countries with the resources the future requires are the same countries least able to negotiate the terms on which those resources are extracted. That's not a coincidence. That's the loop working exactly as designed. When you have debt distress, you accept unfavorable trade deals because you need cash flow. You accept mining contracts with punishing terms because you need foreign exchange. You accept lower royalty rates because you're desperate. You can't say no to anything. The creditor holds the leverage, and the more indebted a country becomes, the more this dynamic accelerates. Countries in debt distress export more frantically, which floods markets, which lowers commodity prices, which makes debt service harder, which requires more borrowing, which increases debt distress. It's a downward spiral, and it's self-reinforcing. The only way out is structural change, debt forgiveness, renegotiated terms, or default. Each carries enormous costs. But staying in the loop carries costs too. Costs paid in human terms, in closed schools, in hospitals without medicine, in opportunities that never materialize. The question isn't whether these countries should have borrowed differently. The question is whether the system that made those loans was ever designed to let them escape. If the system has produced the same result, debt that grows faster than the ability to repay it, in country after country, decade after decade, across different continents, different governments, different political ideologies, then at what point do we stop calling it a failure? At what point do we admit that the loop isn't broken? That it's working exactly the way it was built to work? That the only people it wasn't built for are the ones still trapped inside it? Because here's what the numbers show. Countries with debt loads above 80% of GDP grow more slowly. Countries above 100% grow even more slowly. They invest less in education. They invest less in healthcare. They invest less in infrastructure. They become poorer, not richer, the more they owe. This is documented. It's measurable. And it persists despite decades of promises that structural adjustment would bring growth, that liberalization would attract investment, that opening markets would generate revenue. The theory hasn't worked, but the practice continues. Maybe that's because the theory was never the point. Maybe the point was always the extraction. The flow of resources from poor countries to rich ones, smoothed by the language of development and aid, legitimized by signed contracts and IMF stamps. Or maybe the system just broke, and nobody has the political will to fix it. Maybe debt has become so normalized that we can't imagine an alternative. Maybe countries will just keep paying forever, and nobody will ever ask if there was another way. That possibility might be the most uncomfortable one of all. The debt loop isn't a glitch in the system. It's a feature. Countries borrow in foreign currency, commodity prices fall, interest compounds, and they borrow more just to pay what they already owe. The math is designed to be inescapable. 54 countries are in debt distress right now, and the loop keeps tightening. If you want to understand global inequality, understand debt. If you want to understand why poor countries can't invest in their own futures, it's because they're paying for their pasts. The question is whether they should have to, and whether the system was ever designed to let them escape.